everyone, welcome back to the channel where we make financial mysteries fun and understandable. Today, we are diving into something that can either boost your portfolio or shrink your savings: interest rates. They are like that quiet guest at the party who actually controls the music. So, why should you care about interest rates? Because whether you are investing in stocks, buying a home, or traveling abroad, interest rates are pulling the strings behind the scenes. Intrigued? Let's break it down. Let's start with the basics. What exactly are interest rates? Think of them as the cost of borrowing money or the reward for saving it. If you take out a loan to buy a car, you are essentially renting money from the bank and they'll charge you interest. On the other hand, if you save money in a bank, they are kind of borrowing from you, so they pay you interest in return. Example, let's say you borrow rupees 10,000 to buy a car at a 5% interest rate. That 5% is what you'll pay the bank over the year as rent on that money. Now, imagine if the bank decides to raise that rate to 8%. Suddenly, that car loan is costing you a lot more. So, who decides all these interest rates? Central banks, of course. In India, we have the Reserve Bank of India, and other countries have similar institutions. Central banks control interest rates based on economic health, looking at things like inflation, unemployment, and GDP growth. Example, imagine inflation is like a wildfire, making prices shoot up. To contain it, the central bank might spray water on the economy by raising rates. That makes borrowing more expensive, so people spend less and prices cool off. On the flip side, if the economy slows down, the central bank might lower rates to encourage spending and borrowing. Kind of like opening the fire hydrant. Interest rates have had an equally dramatic journey in India. Take the 1991 economic crisis, for example. India faced a severe balance of payments crisis, and the Reserve Bank of India, RBI, raised interest rates to curb inflation and stabilize the economy. These high rates made loans expensive, but they were necessary to restore economic balance and set the stage for the historic economic reforms that followed. Example, fast forward to 2008, the global financial crisis hit hard. In response, the RBI drastically cut rates to stimulate the economy. The repo rate dropped from 9% in July 2008 to 4.75% by April 2009. These moves weren't just economic policies, they impacted people's ability to borrow, invest, and even hold on to their jobs. Now, how do interest rates affect stocks? Well, when rates are low, it's cheaper for companies to borrow money, which means they can expand, hire more people, and invest in new projects. Investors love this because it often boosts stock prices. So, low rates is equal to happy stock market. Example, take tech companies. When borrowing is cheap, they can invest in all those cool projects and innovations. But when rates go up, borrowing costs rise and companies might cut back on spending. Investors might then see stocks as less attractive, especially if they can earn more by putting their money into safe, high-interest savings account or bonds. The bond market has its own relationship with interest rates, and it's like a seesaw. When rates go up, bond prices usually fall. Why? Because if you hold a bond paying 3% and new bonds are paying 5%, suddenly your bond isn't as attractive, so its value drops. Example, imagine you are holding a bond at a 2% rate and suddenly the Fed announces a rate hike. Now, new bonds offer 4% and investors would prefer those, so the price of your bond goes down. This inverse relationship is crucial for anyone who invests in bonds. And don't forget currencies. Interest rates affect how attractive a currency is to foreign investors. If a country raises rates, investors might flock there to get higher returns, strengthening that currency. But if rates are low, the currency can weaken as investors look elsewhere. Example, let's say the RBI raises rates while the Fed keeps them low. Foreign investors might flock to rupees over dollars, strengthening the rupee compared to the dollar. This can have huge effects on everything from travel to import-export prices. Now, let's explore some real-life examples to bring this theory closer to home. During demonetization in 2016, when high denomination currency notes were withdrawn, the Reserve Bank of India played a critical role in stabilizing the economy. It gradually reduced the repo rate to boost liquidity and encourage lending, helping businesses and individuals adapt to the crash crunch. Example, fast forward to the aftermath of the COVID-19 pandemic in 2020. The RBI responded decisively by slashing the repo rate to a historic low of 4%. This move fueled lending and investments, providing much needed relief to industries and individuals. However, it also raised concerns about inflation as the economy started to recover. These actions by the RBI didn't just influence the financial markets, they affected everyday lives, from home loan interest rates to the growth prospects of small businesses. So, to wrap up, interest rates are like the conductor of a financial orchestra. They set the tempo for the economy, influencing everything from stock markets and bond prices to the value of your currency. Whether you are a new investor or a seasoned pro, understanding how rates work can help you make smarter financial decisions. Thanks for watching. If this video helped you understand the impact of interest rates, make sure to like, subscribe and hit that bell for more financial insights. Share this video with family and friends who want to be a bit more savvy about their money.